First and foremost, I'm happy to be here and hope that everyone is doing well despite the global pandemic and our social climate. My name is Kim Bourne, and I'm a PACE alumna from the class of 1993. I'm the CEO of Playfair Planning Services and a certified financial planner. I guide clients along their financial journey, and I'm delighted to be here with two of my colleagues and fellow PACE alum, Kevin Birdsall and Robert Demmett. We are delighted to connect virtually and simplify some of the complex tax legislation during this unprecedented period. I will be your moderator today. We also appreciate Michelle Camardella, Associate Director of Alumni Relations, and Mark Potolsky, Director of Plan Giving at Pace University. Before we dive into today's program, let's just take a moment to go over a few logistics and get familiar with our technology. Firstly, all participants will remain in mute mode for the program. On the upper right-hand corner of your monitor, you will see some icons where you can either type in a question or comment in the question or chat section. We will answer the questions toward the end of the program. Secondly, today's webinar will be recorded. And lastly, as a disclaimer, our program is designed to be general in context, so any specific questions about your personal situation can be directed to your financial advisor or tax advisor. And we also are open for you to reach out to us to discuss anything about your personal circumstances and more specifics after the program. It's my pleasure to introduce Kevin Birdsall, who has been in private practice for almost 20 years. He received a BBA in accounting from Pace Pleasantville in 1989. His MBA came from Fordham University, as well as an estate planning certificate from Villanova University. Sorry, from, yes, is that right?
Yeah.
He's also pursuing a master's degree in taxation from Charles Whitger School of Law. His professional affiliations include the American Institute of CPAs, the New Jersey Society of CPAs, and the NJCPA Planning Council and NJCPA Bergen County, where he serves as chapter director and board member. Kevin is a licensed CPA in New York and New Jersey. Additionally, Robert Demmett is a partner at Witham, a tax accounting and advisory firm with over 30 years professional experience. Robert is also a certified public accountant in the state of New York. He specializes in tax and financial planning for high net worth individuals and other tax and compliance issues for partnerships, corporations, and other entities. Robert advises on state and gift tax planning for families holding real estate. He received his BBA in accounting from Pace's Lubin School of Business in New York City in 1984, and his master's in taxation from Baruch College in New York. So without further ado, let's begin our conversation today with the CARES Act. Many of us have already benefited from the extended deadlines for paying taxes and contributing to IRAs from the CARES Act. But Robert, could you tell us a little bit more about some of the benefits that have resulted from the CARES Act, specifically in the areas of penalty hardship withdrawals from individual IRAs and the RMD waivers for 2020?
Sure, thank you, Kim. So the main purpose of the CARES Act was a stimulus bill, and the purpose was to generate liquidity for not only businesses that were hurt by the coronavirus, but also for individuals who were hurt by the coronavirus. So one of the things that they looked at in generating liquidity was allowing individuals to borrow from their pension plan or to withdraw the money from their pension plan without penalty. So the normal rule is that when you withdraw money from a pension plan, not only is it taxable to you, but if you're under 59 and a half, it's also subject to an early withdrawal penalty of 10%. So you pay your tax and you pay your penalty. The CARES Act eliminated the penalty so that you could withdraw money up to $100,000 from a pension plan and not be subject to the 10% early withdrawal penalty. However, they did not eliminate the tax. The tax is still there, but they did give you some mitigating factors. Number one, they allow a 3-year period of time for you to put the money back into the pension plan. So if you withdraw $100,000 in 2020, you have until 2023 to put that money back into the plan. So it could be used as a short-term loan type of thing to help you through the difficult times. The other provision that they put in is that they allow you to pay the tax on that withdrawal over a 3-year period. So instead of paying the full tax on your $100,000 withdrawal in 2020, you could spread that tax over 3 tax years. It's another benefit. The thing to be careful of here is that if you do repay the pension, the amount that you withdrew, that you may be required to go back and amend tax returns to get back some of the tax money you paid. So if you decide to repay it in 2022, for example, you would have to amend the 2020 return and the 2021 tax return to get back your tax money. So there is additional compliance required. But it's something that people who feel they have a liquidity need, a short-term liquidity need, should look into this. The other provision that the government put in was they allowed for 2020 only for people who are required to take money out of a pension plan, what we call the required minimum distribution, to defer it and not take anything out for 2020. What they found is, especially in March, when the stock market took a significant reduction in value, they found that people were forced to withdraw money from a pension plan based upon a January 1st, 2020 value, while that value dropped by 20, 30% by the end of March. So that by forcing withdrawal, it was affecting the growth of the pension plan for future years. So they said for 2020, if you decide not to take any money out of your pension plan, even though you're required to, we will not penalize you for it. So many of my clients have decided not to withdraw their minimum distribution in 2020.
Great tips, Robert. We know there's a lot to cover with the CARES Act, so thank you for bringing those 2 very important retirement features to light. Kevin, could you also shed some light on some of the additional provisions and the relief that has been provided under the CARES Act, maybe starting with expanded unemployment benefits?
Sure. So Kim, as you said in the beginning, the CARES Act, it was anything but simple as it was rolled out in late March, as we're all aware, and things are still evolving. So specific to unemployment, unemployment is typically managed at the state level. And basically what happened is when the CARES Act went into place, they created the federal pandemic unemployment compensation, which was an additional $600, which is now, surpassed and expired. That was through the end of July. At that point, then what kicked in was the pandemic emergency unemployment compensation. So under the CARES Act, you were given 26 weeks of unemployment if you met the requirements. When that expired and when the $600 expired, then after that, the emergency relief program kicked in, which was an additional 13 weeks, which we're in the midst of right now, of wrapping up. That will be completed in December. In parallel to that, so many folks were concerned because the end of July, the $600 had expired and relief was needed. So basically what happened was people reached out at the state level and the governor level, and they reached out using FEMA funds. So basically what ended up happening is that you had the FEMA lost wage assistance program, which basically what that allowed was an additional $300 for up to 6 weeks, which was from when the 600 had ended in late July. This kicked in early August for 6 weeks through September. So now we're in that emergency relief program of the 13 weeks, which will end. And then specific to New York and New Jersey, I'm focusing on those 2 states since probably most of the folks in the audience are primarily covering those states. There's an extended program for 20 weeks that will kick in as well. So significant amounts of relief in this space and very much needed across everyone. But very complicated because at the state level, the states were executing this plan many parts of which covered federal. And this was really a first where typically the states manage the entire unemployment program. And this was a first where the states had to handle both state and federal, and their systems couldn't handle the volumes and the complexity of the additional pieces, which is what's caused beyond significant delays for everyone.
Absolutely, Kevin. And for the first time, people who were self-employed could also collect unemployment, right?
You got it. Exactly. Yeah.
Yeah. Kevin, tell us a little bit about student loan provisions. For those of us who might be in a situation where we still have open student loans, there was relief on that front as well?
Yep. So the original CARES Act extended student loans through September 30th of 2020. And then there was a subsequent update that the president signed off on that allowed that to be extended till the end of the year, meaning December 31st of 2020. But what's important for everyone in this session to realize that it covers federally owned student loans. So not private student loans. And you may say, okay, well, what's a federal student loan? So that covers Stafford loans, PLUS loans, and so forth. So just very important that it must be specifically a federal loan to be under the extension rules.
Great. And we also have some provisions that make it easy for all of us to give to Pace University and other charities that we love and get some tax benefits. Tell us a little bit more about those exciting changes.
Sure. So we have the charitable contribution. So interesting things, and there's going to be two big tips I'm going to give you today. The first one is coming up right now because drafts of the tax forms have come out. So I'm going to tell you specific line items for things if you're preparing your own taxes of things to watch out for. The first is about to be communicated. So relative to the charitable contributions, each of us, even if you're married and filing a joint return, you're permitted a $300 charitable contribution. And we know when the Tax Cuts and Jobs Act went in place in 2018, that most of us went to the standard deduction. We were no longer itemizing. And so we lost, typically all the charitable contributions we were making and so forth, and mostly SALT deductions that we were getting, significant deductions. So when we transitioned over to the standard deduction, there was that loss on the charitable contribution side. Well, basically under the CARES Act, they're permitting this year a $300 above the line deduction. So even if you itemize, even if you take the standard deduction, you will still be permitted to take the $300, assuming that you actually made contributions of at least $300. And if you're filing a joint return with a spouse, it's still only $300. It's not per person. The important thing to note here, so the IRS has designated on the Form 1040 line 10B to classify that $300. It has its own line item. And the other big point here is that also up until now, there's been a restriction on the amount of cash donations. So it was permitted up to 60%. They're permitting this year and this year only that you're permitted to go up to 100% of your adjusted gross income. So very significant change.
Absolutely. Great opportunities to make those year-end donations. And then, Kevin, can you just give us a little bit of insight into the stimulus checks? There was a lot of confusion at some point. Some people received, some people didn't receive. Some people heard that it's actually in advance of monies that will be claimed on the 2020 return. Help us to understand what we need to do with regards to our stimulus payments.
So we have tax tip number 2 on the forms coming up in a second that I'll inform you of. So there has been a lot of confusion on the economic impact payments. So for those, just kind of going back slightly, for those that hadn't filed the 2019 return as they began dispersing the funds in early April, they used your 2018 tax return information as an early signal, whether you could get. So many of you may have, if you were eligible, you may have gotten your either 1,200, 2,400, or a variation of that, based on not even filing your 2019 return. That's fine. There's no, one of the key signals here is there's no requirement to pay anything back. So if your income level changed and you were not eligible in 2019, but you were in 18 and your check was based on your 18 filing, that's fine. You accepted the funds and you moved on your way. If you didn't meet the requirements based on 18, but you did meet the requirements when you filed your 19 return, you may have also gotten then your payment at that time. Many folks got things also in the form of prepaid cards, and that's what caused a lot of confusion. In the late May, there was a large disbursement on cards, and many folks still can't access those funds. So that's a challenge in itself of transferring the funds over to your bank. If you're in the scenario where you weren't eligible in 18, you weren't eligible in 19, but now lo and behold, you're eligible based on 2020 income levels, then basically what'll happen, and you will get that, instead of getting a formal check, you will get that in the form of a credit. And that credit, basically, when you go through the calculation, even if you didn't get the full amount based on 18 and 19, that you still had, if you're a single filer and you're able to get up to 1,200, and let's say you got 800 to 1,000, and you still have, 200 to 400 out there, when you file your 2020 return, if the income level is such that you're able to take advantage of that additional amount, then you will get that in the form of a credit on your 2020 tax return. And this is another tip that the IRS has designated line 30 of the 1040 to capture that credit. And like I said, the credit only goes one way. It's money's back to you. There's nothing offset where you owe any funds back to the IRS in any situation. The only situation where monies have to be returned is if estates. I had many clients that were deceased and checks came in for them, and those had to be physically returned. So if you're in that situation, where, unfortunately a loved one passed either in a previous year or earlier this year prior to the check being received, in those cases, the funds do in fact need to be returned to the IRS.
Great. Well, thank you for clarifying that, Kevin. We can't cover everything, but one other thing that we want to just touch on would be the relief for businesses. Most of what we talked about so far was relief that was provided to individuals. What do you think of some of the important things that business owners need to know about the CARES Act?
We'll focus on the main ones, the payroll protection plan loan. There are other ancillary programs that are out there, but I think most of the questions that I've seen that have been focused on the PPP as we know it. And really the big change that went into place. So you had the CARES Act. Subsequent to the CARES Act in early June of 2020, you had the Flexibility Act of 2020, which was an update to the CARES Act. And when that came out, that permitted what was originally within the PPP program that covered basically 8 weeks of use of the funds and, all sorts of parts of the calculation that go into it, way beyond the scope of us being able to go through all of that here. The key message to deliver was that extended from what was an 8-week look on use of those funds to a 24-week use of those funds. And that significantly enabled the small business owner that was trying to use the funds for payroll, for rent, and in some cases, insurance and other things. They now, over a 24-week period, they were permitted to use it basically 100% for payroll. And that permitted the business owner a longer period of time. So that's one of the main drivers of that program. Other pieces of it were that it extended also a look at the employee base periods and so forth. So we're in the throes now where folks are submitting applications for forgiveness. So that's the big thing that's going on right now. And the other key message I want to deliver here is deductibility. So using those funds by the small business owner, there's been a lot of conversation of, well, if I used it on payroll, if I used it on rent, can I still deduct those expenses when I go ahead and I file my business tax return? And the IRS has officially come back and said that it is not permitted for you to deduct those expenses. So whatever you use those funds on, you are not permitted to double dip, if you will, and use those. Once again, still in discussion, but based on right before Thanksgiving, the IRS did issue that guidance that you're not permitted to deduct. So that's for the business owners out there. You're going to need to be very careful and segregate the funds when you used your PPP loan money. Make sure you're segregating what it was used for, and make sure from a preparation of the tax returns that you're only deducting the expenses that were in excess of what the PPP loan disbursement money was used for.
Excellent. Thank you, Kevin. As we prepare to shift gears to talk about the Secure Act, if there are any questions about the CARES Act, now would be a good time to go ahead and put those in the chat. Questions that came in beforehand, someone inquired about using the PPP money or SBA loan for health insurance. Did you have any thoughts or advice there, Kevin?
Sure. So the important thing here is those funds can only be used for, I think the question was, it was from a business owner itself. So you can only use the PPP funds for group related plans. So not for a business owner that's not in a group plan, but still paying himself out of the S Corp or whatever the business entity type is. If it's not group related health insurance, not deductible and not able to use as part of the forgiveness program. That would be, and the other limitation is for owners and employees, when you're using, if you're using it toward health insurance that's in a group plan, there is a cap, a limitation on how much you can use of up to $20,833. I just want to deliver those two pieces. That was a very good question.
Yeah, and then with so many people working from home, I think there was some curiosity around any tax benefits that could be claimed from working from home.
So another good question. So unfortunately, this was even pre-COVID, pre-CARES Act, going back to when the Tax Cuts and Jobs Act went into place late 2017, starting 2018. Unfortunately, it's suspended where you would classify, if you're an employee working from home in a home office, it suspended the use of miscellaneous deductions. So you're not permitted, unfortunately, to take a home office. You're not permitted to cover, I think there was another question about, can I use it to laptop and expenses that I'm not reimbursed for? Unfortunately, none of that is permitted. That was all, and that has not changed as of this moment. Not to say it may not change, but as of right now, there has not been any relief in permitting that, because of COVID. We're still working under the Tax Cuts and Jobs Act.
Okay, a lot of questions are coming in, but we'll just take one more, which is inquiring about the $600 unemployment payment, whether it's taxable or not.
That would be, yes. So everything unemployment related would all be taxable, yes.
All right. So hopefully we'll have time to circle back to some of the other questions, but just so we cover our content, let's dive into the Secure Act. The Secure Act actually was passed toward the end of 2019, and it provided vast coverage, but it kind of got somewhat ignored because coronavirus came and the CARES Act kind of took precedence. But there's a lot of good things that we need to be mindful of with the Secure Act. It really was designed to address the retirement crisis and provide opportunities for us to be able to put away more funds, making it easier for small businesses to offer 401k plans to employees by providing tax credits and collective multiple employer plans, as well as removing the minimum age for retirement contributions, which was formerly 70 and a half. Robert, could you tell us some more about the impact of on retirement income reform that has been put into legislation with the Secure Act?
Sure, Kim. So as you said, there were many provisions in the Secure Act that were taxpayer friendly, including the fact that you can continue contributing to your IRA even after turning 70 and a half. the old law was once you reach 70 and a half, you can no longer make a contribution to an IRA. That was done away with the Secure Act. But one of the provisions was not very taxpayer friendly. The provision really was a revenue raiser. And that was what happens when you inherit an IRA, right? So the old law said, if you inherit an IRA, you're not a spouse, but a non-spouse person inherits an IRA, they get to stretch that IRA out over their life expectancy. So if you take someone who's 35, 40 years old, inherits an IRA, they're allowed to take that money out over their life expectancy, which could be, 50, 60 years. And just think about all the growth that happens in that tax-free account. So by leaving the money in and only taking out a minimum amount, there's a tremendous amount of growth that can happen in that IRA. The Secure Act changed that. They no longer allow you to take that out over your lifetime. Instead, you must withdraw the full IRA within a 10-year period. Doesn't say you have to take it out every year annually. It just says after 10 years, the amount has to be withdrawn from the IRA. So it stops you from leaving it into an IRA account and allowing it to grow tax-free. There are certain exceptions. For example, a spouse continues under the old law, she could continue taking it out over her lifetime. There's exceptions for minor children. But the general rule is now that you have to take out that IRA. If you inherit an IRA, you have to take it out over 10 years. And really it leads us to the Roth IRA, which I'm a big fan of. Just to give you a quick background, as everyone knows, a Roth IRA is different than a regular IRA because a Roth IRA is not deductible when you make the contribution. So you don't get any deduction. It's post-tax money you're contributing to a Roth IRA. But all of the growth in a Roth IRA, as long as you meet certain requirements, all of that growth in a Roth IRA is never taxed. So that you could take that money out after 30, 40 years of investing, and there's no tax liability on that Roth IRA. So, another thing you should be thinking about is, does it make sense to take a normal IRA account and convert it to a Roth IRA? And I think it's something that people should look at. We advise people, especially business people who have bad years, right? Everyone has a bad year where their income is low or their income is actually, non-existent. Those are great years to take out to convert your normal IRA into a Roth IRA because you're in a very low tax bracket. So it's a good year to do that. And it's an estate planning tool where we have clients who are subject to the estate tax. If they convert their normal IRA into a Roth IRA, there's a big tax liability that comes out not out of the IRA's money, but out of your own money. So it's a good use of your funds to pay taxes pretty much for your beneficiary, which reduces your estate. So there are a lot of great provisions regarding the Roth IRA. I think it's something that's overlooked, and people should think about using those provisions.
Thank you, Robert. A lot of our discussion has been focused on federal legislation. However, there are always local implications whenever we're dealing with taxation. What are some of the important updates that we should be aware of with regard to our various localities or municipalities?
So this goes under the category of nothing simple. Most states tax an individual based upon where they earn their income. So that if you're working, let's take Pennsylvania, for example. If you're working in Pennsylvania, Pennsylvania has a right to tax you. So that's the normal rule, but there are certain states, there's 6 states that have a different rule that says if you're working in a different state, for example, New York State has this rule. If I'm working for a New York State employer, but I'm working in New Jersey, if it's for the convenience of myself or my employer, the New York State holds it's still income subject to New York State tax. So think about it for a second. So I'm working in New Jersey, but I'm still subject to New York State tax because the state will argue it's for your own convenience or it's for your employer's convenience that you're working in New Jersey, right? So I'm working in my house in New Jersey. It's for my own convenience. The state will say, well, that's subject to New York State tax because it's a New York State employer. So what happens with the coronavirus where everybody is working from home? So even though I have someone working in New Jersey, New York State is still taxing that because the employer is in New York State. And New Jersey has a rule that says, we're going to tax you where you're physically located, where you're physically doing the work. So if you think about that person, they could be subject to New York State tax under the convenience of employer rule, and they could be also subject to New Jersey tax because that's where they're physically doing the work. So there's this whole conflict happening. New York State just recently came out and said, we are sticking to our rule. We understand the coronavirus is causing hardships and causing people to work in different ways, but we still are sticking to our rule that if you're working out of the state for a New York State employer, it's subject to New York State tax. New Jersey came out and said, look, we're not going to push it, even though we have a right to tax you because you're working in New Jersey. We're not going to tax you, but we are studying the issue because we feel that, especially with New York State, that there are many rules that New York State puts in place that puts New Jersey at a disadvantage. So they created a group that's studying this issue, and we're waiting for their guidance. But this is something that we are advising clients to be careful of. There could be a situation where you're subject to two taxes, what the state where you're working in and the state where your employer is. And there's also a whole discussion, a whole issue around businesses as to how they allocate their income among states. One of the allocation factors is where your employees are. So that may have an effect on how your business income is taxed for businesses. There's also issues as to whether you're held as a resident. I have a client who lives in New York City, but has a house in Greenwich. And he's moved to Greenwich in March, and he's going to spend more than half a year in Greenwich. And Connecticut, says if you spend more than half a year in Connecticut, you're a Connecticut resident. And New York State could argue he's still a New York City resident because that's really his domicile. So there's a lot of traps. Or my advice is be careful because it could be very expensive. And if you fall into one of these situations, seek out advice.
Great advice, Robert. And we did get some questions before the program. Now would be a good time if people have questions relating to the Secure Act, retirement, state rules. Go ahead and put them in the chat. And I'm going to just pose a couple questions that came in beforehand. One had to do with how can we direct an IRA, RMD to a charity without it flowing into our income stream?
So in order to do that, you can't touch the money. So you have to give direction to your custodian to tell them to direct the money, to wire the money directly to a charity. So as long as you don't touch the money, that's fine. It will not be income on your tax return. So that amount that's contributed to the charity is not income on your tax return. You report the amount, but you don't bring it into the taxable column. So you just have to, the general rule is don't touch the money, have the custodian directly give it to the public charity.
Mm-hmm. Another question was, if a dividend is paid and reinvested, can the taxes be avoided simply because the dividend is being reinvested?
No. So it's deemed to be two transactions. One is you received the dividends, and the second transaction is you went back and purchased additional shares. So that dividend is still taxable even though you reinvested into the stock or to a fund.
Great. We will go ahead and transition on to talk a little bit about the pending legislation. Now that we have officially have a result for the election, and we know there was a lot of talk about tax increases under a Biden-Harris administration. We can't predict what will happen. We know that we have a divided government, so we don't want to be overly concerned about it, but I think it's good for us to have some idea about what could be coming down the pipeline, and any advice, Robert, that you might want to share about what, if anything, people should do as we look ahead to be prepared for new tax legislation. So we heard about tax rates on individuals earning over $400,000. maybe you want to share some of the other things that we've been
Sure.
hearing. What are you advising people to do about this?
So Kim, our advice is don't panic. Don't do something before, before this, we figure out what's going on. In order for Biden-Harris administration to get these tax rules passed, they have to get through through Congress. And we still don't know where Congress is going to fall as far as Republican or Democratic. So don't panic, but be aware. So, for example, one of Biden's provisions is that anyone over $400,000 will go from a 37% top tax rate to a 39.6% tax rate. That's a provision that we think if he has even a Republican Congress may have a chance to come to get passed. The other provision where he said he's going to do away with capital gain tax rates, that's only for people who have income over $1 million. So if you have income over $1 million, they're saying we're going to get rid of the preferential tax rate. Right now, a capital gain, a long-term capital gain, is taxed at 20% versus 37%. So over $1 million, Biden's plan is to do away with that preferential tax rate and have everything taxed as what we call ordinary income. I think that's a stretch. I think that's something that will be very difficult to pass. So I wouldn't do anything this year, to try to avoid that. What we're advising clients, if you're able to accelerate income, you know what you have this year. You know what the tax rates are in 2020. If you're able to accelerate income and you're willing to pay the tax, this may be a good time to do it. But we're not telling people to do anything drastic. The other issue under the Biden-Harris plan is the estate tax. The current lifetime exemption, the amount that you can give away over your lifetime, is about $11.5 million. The proposal is to bring that down to $3.5 million, maybe $5 million, which, by the way, is going to happen over time anyway, because that $11.5 million expires, I believe, in 2023. But the proposal is to do it in 2021. I have many clients who are gifting to use up their lifetime exemption in 2020, just in case. And the other provision that is interesting, and it was tried before, is upon death, you receive a stepped up value, a stepped up basis in all of your assets. So in your residence, in your stocks, and all your assets get stepped up to whatever the fair market value is as of date of death. One of the proposals, again, is to do away with that step up, so that even if you're not subject to the estate tax, and you have a house that you bought for $100,000 and today it's worth $1.5 million, if you don't receive that step up, the estate or your beneficiaries can be subject to an income tax on that growth. So it's a big concern. It's another provision where we don't think it's going to be able to get passed, but it's something to be aware of.
Yeah, absolutely. Thank you, Robert, for sharing those. And then Kevin, there are also some tax credits that President-elect Biden wants to put on the table. Can you share a little bit about some of the tax credits that he wants to implement and those that he wants to enhance?
There are, and I would say, once again, they're proposals. So what I'm going to share are just basically what we're aware of right now. But there's a tax credit out there for just about everyone, wherever you are in your life journey. So the first one has to do with a new caregivers credit. So typically what that would be for would be within the family. It's more or less, where you're informally caring for a loved one at home. And there's talk of a credit that would be up to $5,000, as opposed to formal care, third-party caregiver coming in. This is family being the caregiver for a loved one. So that's something brand new. Once again, we don't know much more than that, other than it's right in the $5,000 range that credit would be applicable for. There's also talk about bringing back, for all of you that would be first-time home buyers, you may want to just delay that planning a little bit. There's talk about bringing back the first-time home buyer credit that we had from 2008 to 2010 that had expired. There's talk about bringing that back, but at a much higher level. So it would come back at about a $15,000 credit level, which would be very, very nice. Once again, to stimulate purchases. We know that the real estate market right now is very hot, specifically in our tri-state area. But this would stimulate the first-time buyer, to having funds for down payment and so forth. The other one has to do with a renter's tax credit. So this one's going to be for the moderate and low income folks. And really what they've started to look at was the threshold of 30% of your income for those that are moderate and low income. They want to put a cap on that. No more than 30% of your income would be used toward rent and utilities. That's about all we know right now. There hasn't been kind of that dividing line of what the income level is going to be, but they really, with everything, all the abuse that we saw during COVID, and once again, there's two sides to everything. If you're the landlord, obviously you have property taxes and your own expenses, but they really want to mediate that by having the renter's credit. And the last one's very interesting. I just picked a couple that I thought would be interesting. The last one's a tax credit for related to retirement contributions. So for those of you that are currently working or retired and were working and contributing to a 401k, 403b, etc., where that was all reducing your taxable wages on a pre-tax basis, there's talk now of equalizing things in the form of a credit that you would basically, for dollar for what you contributed, you would get that in the form of a credit instead of it reducing your pre-tax wages. And for those low income earners that were contributing significantly and were at a lower tax bracket, they weren't, clearly in today's world, they don't get as much of a tax benefit to the high income earner that's contributing in a much higher tax bracket is getting a much more significant impact of those contributions today. So this would equalize that of allowing it in the form of a credit based on what you contributed to your respective retirement plan. So I just picked a couple to throw out there, but like I said, we don't know much more than what we were made aware of during the campaign and so forth.
Great. Thank you. Thank you for sharing these things and also for managing our expectations, because as we know, we can't rely on what the government may or may not do, but at least with all of these great tips, we can position ourselves and be prepared for whatever comes our way. To our audience, feel free to go ahead and ask any questions about some of the topics that we covered today. I'll just float some other questions that came in beforehand while we continue to monitor the chat box. Someone inquired about the tax implications of selling a home and not buying another home. So that sounds like a person who might have been familiar with some of the old tax rules about sale of home. Yeah.
Good question. So the purchase of a new home has no impact on the sale. So basically you're allowed in today's world, you're allowed up to a $250,000. If you're a single person, single owner, you're allowed up to a $250,000 exclusion on that gain. So what your ownership value is in the home plus improvements versus what you're selling it for, if that difference is $250,000 or less, there is no capital gain. And the same goes married couple, you double that number to $500,000. So those rules are not changing, and it's not anything that's triggered whether or not you purchase a new home. There are other things out there that you could certainly look into, but just to keep the focus on in that direction, there's no change to that.
Excellent, excellent. There was also a question about assisted living expenses and deducting any type of expenses related to assisting living. Are there any comments on that?
There is a possibility that some of those assisted living expenses are qualified for medical expenses, which are deductible. certain limitations on deductions of medical expenses. They have to exceed a certain percentage of your adjusted gross income. But what I advise is to contact the assisted living facility. They have done studies where they say a certain percentage of the monthly fees are deductible as medical expenses. And I've seen it as high as 100%. So it's certainly something that you should be looking into with the assisted living facility.
Mm-hmm. All right. And just looking at some of the questions that have come into today's chat, home office expenses that are incurred while volunteering. And I think there was other questions about like perhaps utilizing equipment, buying a computer, for example, that is used in a volunteer capacity. What are the tax implications of expenses related to volunteer work?
I would say to be very careful in that space. So I'm very cautious with my clients as I'm advising them with anything that comes to charity and deductibility. So we know in today's world, they're clearly, you're able to deduct mileage, 14 cents a mile for charity work. But I would strongly recommend being very cautious. If there's laptops, home office would not be permitted. But anything related to equipment and things like that, the first thing is you need to look at the organization you're working with. Is it in the eyes of the IRS, is it a tax exempt organization? Or you in your mind are saying it's volunteer work, but it's not in fact a charity. So that you need to look at very closely to start with, but I would be very cautious of, home office, no, and related to equipment and things like that. If it's something that 100% of it is being used for that charity work, you could look at it. But in the eyes of the IRS, if they're gonna say clearly you're using it for personal use. So I would stay clear of that completely.
Mm-hmm. And there was a question about whether Kevin had more information about charitable contributions. So certainly if you have another question, go ahead and put that in the chat if there's an area that you'd like to take a deeper dive into. In the meantime, there is also a question about college loan forgiveness and asking for opinions about college loan forgiveness being approved. I believe that's probably something also that could be part of pending tax legislation.
There is. Yeah, one of the questions there, I think someone asked whether Sallie Mae loans was included, and if a Sallie Mae loan was taken out after, I believe, 2014, it's not federal. That would be considered private, not extended, and not under the CARES Act program. Relative to graduate loans, so, and looking at forgiveness, I just worked with a client that just finished graduate work. She's now overseas, and we went through the forgiveness process. So I would highly recommend, if you meet those requirements, it's clearly worth pursuing.
Absolutely, absolutely. And then this might be a conversion question. The way it was phrased was, I understand you can put a certain amount of money into a Roth IRA with no tax due in New York. So I'm not sure if maybe you just need to clarify how Roth contributions work, because making the contribution itself is not a taxable event. Is that right?
That's right. That's right. So making that contribution is not a deductible expense. It's you're doing it with post-tax money. And New York State follows the federal, so whatever applies to federal will apply to New York State. And there are certain limitations on your income that limits or eliminates the Roth contribution that you have to look at. So again, it's something, but it's all determined at the federal level.
Mm-hmm. And the maximum contribution that can go into a Roth IRA, Robert?
Somewhere 6,000, 6,500.
Mm-hmm.
That's I haven't looked at it.
Mm-hmm. Yeah, I think you have on your
Okay.
age, right? Yep.
Right. Mm-hmm.
Absolutely. That sounds right. And then someone asked if you are retired and are you able to put money into a Roth IRA? Put money into a Roth IRA from a traditional IRA. So it sounds like, I guess maybe you want to clarify, Robert. Number one, if you're retired and have no earned income,
You have no earned income, so you can't make a contribution to any type of retirement plan because you have no earned income, but you can still do your conversion. So you can still convert from an IRA to a Roth IRA, no matter what age you are. You know, again, you have to do the calculation to see if that's beneficial or not.
Excellent, excellent. And we have someone that just said here, I am married and I have a solo law practice. I file taxes through Form 1040. Would there be a benefit to file the law practice, which is set up as an LLC, separately?
Yes. So definitely if you know you're an attorney, professional, practicing law, you need to clearly, you know, the LLC is limiting your liability. So you are exposed if you are not, you know, just for putting the tax ramifications aside, you are very much exposed if you are just reporting that, you know, through as a sole proprietor. You want to make sure you have that added protection. Now, shifting over to the tax side of it, if you do file and set yourself up as an LLC, then you would be what's called flow-through entity, and then you would be reporting that that income and related expenses would still flow through to your personal return. And I would say so the tax impact would still be the same, but now you're limiting your liability and protection. And clearly in, you know, the litigious world that we're in, you want to make sure that you're protected as a professional, especially as an attorney in whatever area of law you're practicing.
Mm-hmm. Thank you. And we have just reverted back to a couple of retirement questions there. Someone is asking about a traditional 401k fund transferred into a Roth IRA without, is there a limitation to the amount? Can traditional 401k funds just transfer into a Roth IRA without an amount limit?
The answer is yes, you can. Again, a 401k is done at the employer level. So you have to figure out what the employer plan is, whether you could take the money out. Do you have to wait till you terminate service? There's all kinds of rules that are determined by the employer. So you have to meet those rules. And many employers have a Roth 401k, so that instead of contributing to a regular 401k, a normal 401k, you can contribute to that Roth 401k, which is something that we're finding in our practice. A lot of the younger employees are doing now. They prefer to go into the Roth 401k directly.
Mm-hmm. And under the CARES Act, if you didn't take the RMD in 2020, do you have to make it up in 2020?
No. Your 2020 you're not required to take it, and then you're not required to make that up in 2021 or any other year. It's a permanent elimination.
What I would say, just relative to from a tax planning perspective, you may want to look at if you have something coming next year, in addition to resuming your required minimum distribution, that could possibly put you into an additional tax bracket. And you know, you may want to relook at things and possibly take what would have been your RMD this year. So I'm looking at, you know, I have an elderly client. The husband is very ill. They have in-home care for him, and they're in need of, you know, constant, you know, cash flow for the in-home care. So we're relooking at things in lieu of waiting till next year. We may be taking advantage of still some of the what would have been the RMD this year to give them that cash. It keeps them still within a certain tax bracket, and instead of taking balloon payments next year, you know, for all of that care. So you may want to just kind of look, you know, periods out, and you could possibly still look at taking some of your IRA distribution this year, though not required.
Okay.
Point.
Great. Yeah, excellent point. And we have a note, Kevin, that you said that you had several items regarding charitable contributions to share. And we appreciated the $300 contribution that people can take regardless of whether or not they itemize. But we're just wondering if you have any additional tips for charitable contributions beyond the above the line deduction.
No, I would just, because I think there was a question there. So it's $300. If you're filing a married return, it's still just 300. It's not 300 per taxpayer. If you're a single taxpayer, it's 300. But if you're a, married filing joint return, it's still only 300. No, I would just say, the fact that this, this is a little bit of a plug back to PACE is, the fact that the CARES Act included this is to really stimulate, charitable giving. So I would just, kind of charge all of us that we should relook at that, and if it affords us that we can be charitable, and we are getting that tax benefit for us, I think it's something we should all be looking at if we're if it's within our means to do so.
Yeah, Kevin, I agree. And one thing that I might add with regards to being charitable minded and planning tax wise is to have a look at donor advised funds for those people who want to make or might be in a position where you have uneven income. If you have a lot of income in a particular year, whether it be this year or a future year, you could contribute to a donor advised fund, which is a fund that's set up as a 501c3 charity. It can be invested. You can think of it similarly to like a healthcare spending account where you put money in there, you get the deduction, and then you dole the money out to the charities of your choice over time. The reason that you might want to do that is you may not be ready to figure out, what charities you want to make a significant gift to. You might want to manage the expectations of a charity. So that's always an option for people looking for more charitable strategies to consider donor advised funds. We are getting close to the top of the hour and want to be mindful of everyone's time. So we really appreciate the opportunity to share with you today. In the words of Jack Canfield, I've lived by one crucial principle since I was 24 years old. I don't blame or complain about the things that I don't have control over, the employees, gas prices, or any of the external things that we can't control. The only thing that I have control over is my response to things. So hopefully our tips that we've shared have helped you to respond in a positive way. And we certainly appreciate your support of the Office of Alumni Relations and for PACE for organizing this session today. Take care, everyone. Be well and stay safe.
Thank you. It was a
Thank you,
wonderful
everyone.
session.